please don't throw anything at me. Maybe I should hide when I talk about this. When the June inflation report came out, it was what's called negative inflation. Costs had actually gone down from the month before. Over the last year, inflation is 3% by the official federal measure, CPI. And the inflation curve has bent. We're broken from the inflation we've had, but the bad inflationary cycle is almost certainly over. You can see it because 3 weeks ago, people who are into financial markets saw a big decline in interest rates on rich people CDs and institutional CDs. The substitute for that is called the 10-year U.S. Treasury. The rates went down on that. And that's why mortgage rates followed coming down some right after that. Because once the marketplace becomes convinced that inflation is no longer going to be ugly moving forward, it means the expectations of what they should earn on their money is lower as well. Particularly when you think about the 10-year Treasury, which is like a rich person's 10-year CD. They're willing to put money into it that they would be locking up theoretically for 10 years. And those rates are way down. So what follows, and has been happening the last really 2 weeks, is what banks and credit unions will pay on CDs is going to be a lot lower, and savings accounts do not trend as quickly lower, but they're coming back down. And, you know, I was like the boy who cried wolf because I predicted this much earlier this year, and it didn't come to pass then, but I was too optimistic at that point about inflation. Now, better late than never, the inflation thing has curved down, and so that's why this is a challenging time if you are a saver, what you do about your money. So there are enormous differences from one financial institution to another with what they pay on savings, what they pay on CDs. And I've beat up on the big banks enough over the last forever, like a millennium. But this is one that's obviously so stark, it's crazy what the giant monster megas pay on savings versus like what an online bank pays, what a credit union pays versus a typical bank. But the biggest deals out there remain for putting money aside longer term in CDs through the discount brokers, the big ones. Schwab, Fidelity, Vanguard can place FDIC-insured CDs at a higher rate than you can find on your own almost always. And this is a great time to maybe push out the ladder if you can afford to. What's pushing out the ladder? So, you know, for the last many years, it made sense for you to do 5 piles in CDs, 1 year, 2 year, 3 year, 4 year, 5 year. Right now, because of the turn in inflation, it looks like it's not a false dawn. It looks like it's the real deal now. We'll see. You would want to tilt a little heavier, getting the best rate you can through one of the discount brokers on 5-year money instead of 5 equal piles. You might want to tilt a little heavier to 5 years. So you're locking in that higher rate for a good time, good long time. As far as savings accounts, you want with savings accounts to make sure you're earning the best rates generally in the marketplace. There are lots of lists out there. We do an abbreviated one at Clark.com. The most exhaustive is at Bankrate.com, but there are many others. And you want to make sure you're dealing directly with an FDIC-insured institution, as we had so many angsty questions, complaints, problems from people who cannot get their money because they put it through a fintech a non-bank that said, many non-banks, that said they were placing the money in a bank with FDIC insurance, but the money never got there, and the money's missing from so many of these. That's why you want your relationship to be through a big discount broker, as an example, going into CDs, or directly with a typically online bank that will be FDIC insured, not through some app that says, yeah, we're going to do this, that, and the other for you, and we're going to put your money over with an FDIC insured institution. I never, ever pictured that was going to be a risk. It sure has turned out to be one. Krista? Oh, one other thing I forgot to mention.
What?
This bears repeating for the 25th time. Do not allow your CDs to roll over at maturity into a new CD issued by your financial institution, because they will cheat you. This isn't a possible cheat you. They will cheat you. It's in Banking 101. Let's see. How can we steal customer money? Way number 12. Or is it number 3? What number is it on the list? I don't remember. But what they do is you buy a CD because they're advertising they got this great rate on a CD. And then when the CD renews, they might pay you 100th of that percent interest, or 1/10 of that, or 20th of that if you just let it auto-renewal. You never do an auto-renew on a CD ever. Actually, that's a never, never, not ever rule.
And if you want to send this to a friend, you can also, well, you could send this podcast to a friend, but we do have a great article on Clark.com on CDs and what to do when they expire.
Before they expire.
Before they expire, sorry.